Before we move on to accounting records, a quick recap of what we have discussed so far. We understood what are goods sent on approval. When goods are sent on approval, the customer has the option to either approve the goods or return the goods within a specified period of time. When goods are sent on approval basis, sale is not immediately effected, though goods are physically transferred to the premises of the customer. When he approves the goods or the specified period is over without returning the goods, sales is said to be effected. Usually, this is resorted to in order to improve sales or to introduce a new product. The accounting records are maintained depending upon the frequency of the transactions. How often do we have goods sold on approval basis? If the transactions are very few, say one every month, etc., then we do not actually keep any separate set of books. We record it as an ordinary sale. Though, I repeat, sale has actually not been effected. It is affected only when the customer approves of the goods or the specified period is over without his returning the goods. So there is no separate set of books here. We record it as a ordinary sale transaction. In case goods are returned, it becomes an ordinary sales return. However, when transactions are frequent, maybe we have around 5 transactions every month, then we do keep a separate set of books. So also, when transactions are many, very many, we have transactions of goods sold on approval, say daily, then we again keep a separate set of books. So we have two kinds. This is occasional or casual, or when transactions are frequent, or when transactions are numerous. In case they are frequent and numerous, we keep a separate set of books. However, these set of books are not a part of the main books. They are not a part of the principal books. They are just called memorandum books. Books maintained only to keep some control over the goods which have been sent on approval and on their related debtors. We shall go into detail in a while. First, let us discuss what happens when accounting records are very, very few. Occasional transactions, casually, sometimes, very, very rarely, maybe a transaction or two a month, etc. As we said before, no separate set of books is maintained, and whenever goods are sent on approval, we record them as an ordinary sale. If goods are returned, we record the sales return. If the goods are approved, the sale transaction has already been effected. Let us just go through the different options. First, when goods are sent on approval basis, as we said before, we record it as an ordinary sale. Credit sales normally is entered in the sales journal, from where periodically the total is taken to the credit of the sales account and the individual customers' accounts are debited. In effect, when goods are sent on approval basis, we treat it as an ordinary sale. The accounting entry, the effect of the entry is actually debtors account is debited and sales account is credited. When goods are returned, it is a case of sales return and we record sales return just as we would do in case of normal sales return. We record it usually in the sales return day book, from where periodically the total is posted to the debit of the sale return account and individual customers' accounts are credited. Basically, when goods are returned or there is a sale return, the accounting entry would be sale return account debit to debtors. When goods are approved, basically that's when actually the sale has been effected. However, we have already recorded the sale transaction here, and therefore when goods are approved, we need not pass any entry. If there are negotiations on pricing, sometimes it so happens that after the goods have been sent on approval, there is a difference in price. The customer may want a lower price for the good and we may agree to the same. There could be an increase or a decrease subsequently after the goods were sent on approval. In that case, in case there is a price increase, we would pass an entry saying debtors account debit to sales. In case there is a decrease in the price, we would just say sales account debit to debtors to reduce the amount of sales and the debtor balance. When goods are neither approved nor returned at the year end, what has happened is that at the year end, the goods are physically lying with the customer. However, these goods actually belong to us. And the sale, since it's a good sent on approval basis, the actual sale transaction has not yet been effected. Therefore, here we need to cancel the sale entry which we had passed initially. So the first thing to do is to cancel the effect of the sales. Sales account debit to debtors. Next, we need to bring in the value of the stock lying with the customer, which actually belongs to us, since ownership of the goods has not yet been transferred. The entry for that would be to debit the stock account and credit trading account. So we say stock with customer on sale or return basis, on sale or return debit to trading account. However, the value of these goods, the stock would be valued at cost or NRV, whichever is lower. A quick recap on how we record goods sold on approval when transactions are very, very few. Basically, we treat them as sales as soon as goods are sent on approval. Therefore, when goods are sent on approval, normal sale transaction, debtors account debit to sales. When goods are returned, normal sales return transaction, sale return account debit to debtors. However, when goods are approved, that is the time when actual sales is effected. However, sale entry has already been passed. When we sent the goods, we passed the sale entry, though sales had actually not been effected, though title of the goods has not yet been transferred to the customer. This is because these transactions are very few, once in a while transactions, and we could maintain control. It is too costly, and there would be no need to keep a separate set of books to have control on the goods sold on approval. Therefore, when goods are approved, since the sale transaction is already been effected, there is no need to pass any entry. If there are negotiations on pricing, if prices have gone up, then we have to increase the amount of sales. So debtors account debit to sales. If the prices have come down, then it would be sales account debit to debtors in order to reduce the value of sales previously recorded. If goods are neither approved nor returned as at the year end, we need to cancel the sale transaction. Therefore, sales account debit to debtors. Sales is not actually effected till the goods are approved, and therefore at the year end we may pass an adjustment entry, a rectification entry, sales account debit to debtors. However, when we physically count stock, this stock will not be there in our premises, but we should include this stock lying with our customer in our books, and we pass an entry for the same saying stock with customer on sale or return account debit to trading account. However, this should be valued at cost or net realizable value, whichever is lower.